Lecture 6. Diminishing Musharakah and Ijarah. This lesson is part of the course Islamic Banking and the Sabbath Pawn Test. It follows the scholarly preprint closely and presents the argument as research analysis, not as a fatwa and not as personal financial advice. This lecture compares co-ownership and lease finance with the economic behavior of mortgage-like debt. For point 2, Diminishing Musharakah, house financing. Diminishing Musharakah is the flagship structure used for home financing by many Islamic banks, including Mizan. It was developed to provide an Islamically acceptable alternative to conventional mortgages. The essence of the contract is partnership. The bank and the client jointly purchase a property. Say the client has 20% of the price and the bank 80%. They form a partnership, shirkatul milk, so each owns an undivided share, e.g., 20% and 80%. The client then leases the bank's share of the house by paying rent, reflecting usage of that share, and at the same time gradually buys the bank's share over time in installments. Over, for example, 20 years, the client buys out the bank's 80% piece by piece until the client owns 100% and the partnership ends. The lease payments adjust as the bank's share diminishes, so the rent portion decreases over time, while the share purchase portion increases proportionately. In theory, both parties share the risk of property ownership during the partnership period. If the property's value falls, the bank as part owner also bears that loss at sale, though in practice, Islamic banks often avoid selling during the tenor. They structure it such that the client is committed to buy all shares. If a disaster happens to the house, both lose according to their shares. Insurance/takaful is usually taken to mitigate this. Sharia boards have laid down guidelines to ensure the contracts remain separate and valid. The partnership agreement, the lease contract, and the sale/purchase of shares should all be independent and not conditional on one another in one document. Usmani, 2002. In Mizan's guide, it's noted, the joint purchase, leasing, and sale of units should not be tied up together in one single contract. Usmani, 2002. Otherwise, it could resemble the forbidden two-in-one sale. But they are allowed to execute them in sequence with mutual understanding. This sequential unwinding of a partnership is what makes it diminishing. When analyzed, the cash flows of diminishing musharakah are almost identical to a mortgage. Part of each monthly payment goes to equity, buying shares, and part is rent, analogous to interest. The major difference is that the bank in theory is an owner and not a pure lender. Does this pass the Sabbath Pawn Test? In a positive light, one could say yes. Musharakah is a genuine Islamic mode of finance rooted in profit/loss sharing. Here, the bank shares ownership, so it is not a creditor with a guaranteed return. If the client defaults or the property value collapses, the bank could suffer a loss on its equity share. This risk-sharing aspect aligns with the spirit of avoiding riba. The bank's profit, via rent and eventual sale of its shares, is tied to the asset's use and value, not simply time. The Quran's spirit of fairness, deal not unjustly, and you shall not be dealt with unjustly, Quran 2:279, is arguably better upheld than in an interest mortgage because if something goes wrong, the bank cannot claim the full house plus extra. It is only entitled to its remaining share and any due rent, not the entire outstanding loan, which in a conventional mortgage could lead to the client losing the house and still owing money if the sale doesn't cover the loan. Diminishing musharakah thus has inbuilt equity and fairness if done right. However, certain practices could undermine this ideal. Often, the agreements are set such that the client is obliged to buy the bank's shares according to a fixed schedule, failing which is a breach. The rent is benchmarked to market interest rates to ensure the bank's return targets. In some jurisdictions, if the client defaults, the bank may treat it similarly to a mortgage foreclosure, evicting the client and selling the property. Ideally, they should then share proceeds by ownership ratio, but some contracts may have the client promising to buy the remainder of the bank's share immediately, which in default they cannot, so it's murky. If the bank effectively guarantees it will get back its principal and a profit come what may, through heavy contractual penalties or third-party guarantees, the arrangement slides back into a de facto loan. The key is whether the musharakah is genuine or not. A genuine one would mean the bank's profit is not 100% predetermined. It will depend on rent payments, which depend on property use, and on the property's resale value if things go awry. A fake one would, by legal drafting, eliminate all uncertainty for the bank, ensuring it gets a fixed yield. Mizan Bank's documentation acknowledges that for diminishing musharakah to be Sharia compliant, certain options that would make it too loan-like must be avoided. For example, the bank should not have an upfront binding promise that the client will purchase all remaining shares in one go upon default. That would resemble a debt obligation. Instead, they usually have unilateral undertakings or gradual mechanisms to keep it technically a partnership. The Sabbath test question remains: is the bank truly partnering, or is it simply lending under another name? If all goes normally, the client's experience is very much like paying a mortgage installment comprised of principal and interest. If trouble hits, in a well-structured Islamic contract, the client and bank should negotiate like partners, perhaps reschedule payments, or the bank takes a hit on profit, etc. Whereas in a conventional loan, the interest just keeps accruing. A classical Hanafi jurist would encourage the former approach. Indeed, the Quran encourages leniency to debtors in hardship, Quran 2:280. And Caliph Umar's practice was to give respite or aid rather than enforce harshly, Abu Ubaid, 2007. If Islamic banks adhere to that ethos, e.g., by not imposing punitive measures beyond actual losses, then their home finance is substantively fairer. In summary, diminishing musharakah, conceptually, is one of the more authentic Islamic financing methods. It passes the substance test when done in good faith because it is built on co-ownership and leasing arrangements. The Prophet, peace be upon him, himself practiced, e.g., the Prophet and companions often jointly invested in ventures, and he leased land of Khaybar to Jews for a share of output, which is analogous to partnership and rent. But to truly distinguish it from a disguised mortgage, Islamic banks must maintain the risk-sharing element. If they end up with risk-free returns, then it becomes a cosmetic change, like calling the interest rent but never really sharing the downside. The real spirit of musharakah is sharing of profit and loss, and that must manifest in the contract's operation, not just its form. For point 3, Ijarah, lease financing. Ijarah is another mode used for assets like cars or equipment. The bank buys the asset and leases it to the client for a fixed period against rental payments. Sometimes there is a separate promise or option that the client will buy the asset at lease end for a token price, in Ijarah wa Iqtina, or in diminishing musharakah contexts. Pure Ijarah is just leasing, akin to conventional operating leases. The Sharia issues in Ijarah are fewer since leasing is a well-recognized contract type. The main conditions are that the rental is for a permissible use, the owner, lessor, bears ownership responsibilities, major maintenance, asset risk to some extent, and rental is fixed and known, or variable by agreed formula. Ijarah differs from an interest loan because the payment is for usage, not for money, and if the asset is unusable or destroyed, the rent should cease. In practice, however, Islamic banks often shift many responsibilities to the lessee via service agreements and insure the asset, so effectively the lessee, client, covers all risks. That again tends to align it with an interest loan from an economic view. Still, one could argue Ijarah is closer to a sale-type transaction in Sharia classification and thus permissible, but if used just to replicate an interest schedule, e.g., many car Ijarah products set rents exactly to equate to an interest-financed installment. It faces the same critique of form over substance. Mizan Bank offers car Ijarah and equipment Ijarah, where they highlight that the bank as owner is responsible for takaful Islamic insurance and major maintenance, etc., which is a genuine difference from an interest-based car loan where the borrower owns the car and bears all burdens. This is a subtle shift of responsibilities that Sharia values. Liability accompanies gain. An owner is entitled to rent because they carry liability of ownership. This is a fiqh maxim. If in reality the bank's liability is negligible due to contracts passed to the client, then the ethical advantage is lost. But at least formally, Ijarah ensures the bank cannot wash its hands completely of the asset's fate, unlike a lender who only cares for his money. In applying this Sabbath pawn test to Ijarah-based products, we ask, is the Islamic bank behaving as a landlord permissible or, as a lender taking no asset risk, problematic? If the bank truly acts like a landlord, even if primarily on paper, the arrangement is not a sham. It's a lease which the Quran and Sunnah allow. If the bank is a landlord who forces the tenant-client to cover every imaginable loss on the asset through warranties, indemnities, etc., then the bank has basically turned it into a risk-free loan from their perspective. Again, the answer depends on actual practice and the specific terms. As you listen, keep the course question in view. Does the structure change the economic substance, or does it only change the route by which the same result is reached? This completes the lesson. In the next step of the course, we continue applying the same standard. Real ownership, real liability, real risk sharing, and transparent economic substance.